Well, it means that the man in the street suddenly starts to look at his bond investments and looking at the negative yield he's really getting if he's buying a core government bond. And if he's looking at credit, there's still obviously some concern about the credit quality, and they start to look for more tangible assets. And obviously gold has been the best example of this phenomenal rally we've had since the beginning of the year. But even the industrial metals, because you can argue, are we really at this stage in the economic cycle ready for a recovery in metals? Maybe not, but so there could be other drivers at play here, and I think the fact that we are having negative interest rates right now is starting to opening up the eyes from investors' perspective that they should look at other assets. Well, I think if we start with gold, there's no doubt that when we started the year, there was two trades that were near certain. That was that the dollar was going to go up and U.S. interest rates were going to go up. And with less than 2 weeks into the year, we had the Chinese devaluation or additional devaluation of the yuan, which changed the sentiment in the market. And basically, investors had to scramble to readjust their positions. And that really kicked off the move that we saw especially in gold. And then later in January, we started to see the industrial metals follow as well. So I think the announcement that the fact that we didn't have any, that we saw a change in U.S. sentiment towards interest rates. We saw what they did in Japan with introducing negative interest rates. That really changed the whole psychology of the market. And commodities, so far this year, iron ore is out in front ahead of gold. So far during this first quarter, quite a lot of the movements that we've seen in the commodities has been just a readjustment of positions, because there was an overly bearish exposure towards metals as we started the year. So if you look at the speculative position in copper right now, it's only last week that it went into a net long position if you look at just the futures market. So we spent the last 6 weeks just getting out of a short into a positive position. So now obviously we need to see what it can from here. So a lot of readjustments so far, and I think that probably leads us to believe that we're now going to see a period of more stable pricing, and then we'll have to see what comes out of China. We can also argue that a lot of the bad news that drove commodities and metals down, they are priced in at this stage. So the situation really needs to deteriorate further in order to justify a renewed weakness in the market.